ahead.
So this is group 10, and this is our analysis of Apple Incorporated. It's presented by myself, Trenton Worley.
Mahmoud Yusuf.
Bethany Branson.
Mickey Carney.
Zhimin.
So we have our table of contents here. This is what we're going to go over. We have a brief background about Apple, the income statement by Bethany and Jimin, the balance sheet analysis by me, the ratio analysis by Yusuf, competition analysis by Mickey. Conclusion, I'm more excited. Next. This is our brief background. We'll try to keep it short. Apple was founded in 1976 by Steve Jobs. The first Apple computer went on sale in 1976 as well. That price listed. The first iPhone went out on sale in 2007, first iPad in 2010, and Apple is currently about 10% of the GDP of the United States with a value of $2 trillion.
Okay, based on the three chart, we can know that from 2017 to 2021, they all have a different growth level. The trend from 2020 to 2021 is most significant. Uptrend in net sales and gross margin, a reasonable guess is better quality and technical level. Better technology, higher price, and more buyers. Better quality, fewer returns and discount. Of course, reduced production cost is also a possibility. The upward trend in data means that more consumers are willing to pay for Apple. Positive net income growth shows maybe Apple is doing a good job of controlling sales costs and other expenses because the price of the product will not exceed the value of the product. So, blindly raising the price is not a long-term strategy. How to reduce production cost and improve sales strategy is the key to meeting company net income growth. That's all. I don't.
Okay, so for further income statement analysis, the net profit margin ratio shows the profitability of a company over the 5-year period of data that we used and how Apple has improved. So I have shown the profit margin ratio and the operating profit margin ratio, and they have had a steady increase over the years, a positive 2.2% change over the entire period, 5-year period is shown, which shows that the company is earning more from business operations to pay for all the costs involved in maintaining the business. Considering the growth Apple has had over the years and its sales, the steady increase of costs to sell its products is fair and shows stability. A steep increase to costs would mean that the firm isn't financially stable. So since Apple's is stable over the 5-year period, it is in a healthy financial position. So I'd recommend to buy Apple stock.
So here's our balance sheet analysis. I have 3 things displayed on the screen: the total current assets and total current liabilities, which just seem to bounce around over the years. And we have the current ratio, which is current assets divided by current liabilities. Now, what this measures is the liquidity of a firm. So the optimal ratio is anywhere from 1.5 to 2. Any higher isn't so great because it will signify an inefficient usage of funds. And larger corporations may not even want to be in the optimal range because with extra money that these large corporations have, there's just way too much money laying around in assets, which could be invested in other places. Apple's goal is a current ratio of 1, net cash neutral. Next. Now we have a statement here that describes Apple's net cash neutral position that they wish to obtain. They've returned over $24 billion to their shareholders to achieve this net cash neutral position. And due to that, retained earnings have dropped. And that comes from appreciation in stock price, the top left graph, an increase in stock buyback, and an increase in dividends declared per share. All of those are inversely related with the retained earnings. And you can see why, as the three graphs I just described are all going up, retained earnings is going down. Next.
So when we look, I'll be talking about profitability ratios. So when we look at the graph, we can take away a couple points. First, we can see all the ratios have been increasing year after year. In fact, return on equity has doubled this year, and return on equity is also the highest ratio out of all the rest. So we conclude that COVID did not really have much effect on Apple's profits. Next. On the other hand, when we look at the Apple total debt to equity, we can see its effect there, as ever since COVID started, the debt has been rising year after year. But I wouldn't worry too much, as most of Apple's assets is liquid, so they would meet all their short-term loans. Lastly, for asset management, Apple has been improving their usage of their assets, as we can see it here in the total asset turnover. As for their inventory turnover, it improved during COVID, but it's been slowing down this year. And lastly, receivable turnover is moderately at best, but it's not the best case scenario.
So the PE ratio for a stock is the price to earnings ratio divided by the growth of the earnings over a specific time. It gives a little bit more information than the PE ratio. The PE ratios that are above 1 are considered overvalued, and then 1 and lower are considered to be a fair stock value. And as you can see by the top ratios, that is considered overvalued, and it's only increased over the past year. Next. Apple is considered overvalued in comparison to the other companies such as L3Harris Tech and Microsoft and Alphabet. L3Harris Tech and Apple are relatively fairly priced. Apple's strength in the market of tech and its sturdy growth are all good signs. And in income statement analysis, we did show that sales have constantly increased because of Apple's new release of products, and keeps customers invested in the company and keeps them relevant in the tech industry. The balance sheet analysis shows that the company has done well in keeping their current ratio above a 1 for the past 5 years, and 1 year having it at 1.5, which means the company has enough liquid assets to meet its liabilities. And then the ratio analysis shows that Apple has sustained growth while the debts have increased sustainably during COVID, because they improved their asset turnover ratios. And then overall, we recommend the purchase of Apple stock, because even though the competitor analysis shows that it is overvalued, the company will continue to grow and it is in good financial health.
Okay.
Good with that.